What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. In recent days, the COVID situation in the Hong Kong Special Administrative Region has blown up. This is not just concerning due to the densely populated nature of the city, but also because commentators have warned that it could be used as a pretext for greater mainland intervention in the city. On Sunday, Hong Kong breached the new threshold of about 2,000 suspected COVID-19 cases, and with authorities warning that it could start imposing rolling district lockdowns to cut off transmission chains. Although on Saturday, Chief Security Secretary John Lee ruled out adopting mainland China strategies of city lockdowns. Hong Kong media reports that the government also announced that children as young as 3 would be allowed this week to receive the Chinese-made Sinovac vaccine. At an internal high-level meeting on Sunday, Chief Executive Carrie Lam expressed that the Hong Kong government will start working with task forces with the mainland as soon as possible to, quote, enhance the city's testing and isolation capabilities by all means, end quote. According to a press release, Lam appointed 5 senior officials to convene 5 task forces that will coordinate with their counterparts with the central government and the Guangdong provincial authorities in the mainland. Kenneth Chan, associate professor specializing in Hong Kong politics at Hong Kong Baptist University, speaking to media yesterday, warned, quote, the outbreak serves as a window of opportunity to introduce whatever China means by its dynamic zero strategy to Hong Kong. The patriots-only leaders in government and the legislature are eager to transplant what they see as the mainland approach to show how it works in Hong Kong, though none of them were able to tell and inform citizens here what exactly they have in mind. Meanwhile, on the mainland, a new outbreak in the wealthy city of Suzhou could be concerning too. The city of 10 million in East China's Jiangsu province rolled out highly disruptive measures after 4 people tested positive for COVID-19 on Sunday. Restrictions have been placed on residents from leaving the city, and large parts of the industrial zone have suspended operations. Now, these are official numbers, just keep that in mind. By Monday, yesterday, the number of official cases was 8. Cases are believed to be Omicron. Okay, next up, key economic and financial developments from the People's Republic of China. Analysts with the Japanese financial outlet Nikkei Asia observed today that New York is ready to see its first initial public offering by a Chinese company in 7 months, writing yesterday that healthcare supplies maker Meihua International Medical Technologies is on track this week to price its debut share sale up to $57.5 million, according to the New York Stock Exchange's online IPO hub. New US stocks usually start to trade a day after pricing. Meihua could have company soon, Nikkei observes. 8 Chinese companies filed IPO registration statements to sell stocks in the United States, documents known as F1s, with the US Securities and Exchange Commission, the SEC, in the 4 weeks between December 30th and January 28th, 2022. 15 other Chinese companies that started their share sale registration earlier, including Meihua, have filed updated documents since December 30th. We remember back in late December, the China Securities Regulatory Commission unveiled draft rules that would require companies to get permission to list overseas. We also remember that rules have tightened on the US side also. Despite the DD IPO fiasco last year, which some of you may remember we covered at the time, 53 Chinese companies raised a total of $15.1 billion through US IPOs in 2021, the highest sum raised since 2014. However, investment research company Renaissance Capital reports that shares of these companies that listed last year were trading at 53% below their IPO price on average as of the 21st of January of this year. Nikkei analysts argue that if Meihua's IPO on the Nasdaq stock market and that of other pending issuers go well, that could help to restore confidence. We will see. Meanwhile, Chinese financial media outlet Caixin reports that a subsidiary of US asset manager BlackRock Inc. received approval to start selling retirement wealth management products in 2 major Chinese cities as China, quote, expands a pilot pension program aimed at boosting residents' retirement income, end quote. According to a notice published by the China Banking and Insurance Regulatory Commission, BlackRock CCB Wealth Management Limited can launch retirement or personal pension wealth management products in the cities of Guangzhou in the south and Chengdu, provincial capital of Sichuan in the southwest, for a 1-year trial period. Over the weekend, the National Medical Products Administration, China's drug regulator, gave conditional approval for emergency use of US pharmaceutical titan Pfizer Inc.'s COVID-19 pill. Commentators point out that this is the first oral treatment cleared to treat patients in China. According to a statement by the drug regulator, Paxlovid will be used to treat adults suffering mild to moderate COVID-19 induced pneumonia who are at high risk of developing severe illness, end quote. Over the weekend, Zhang Guang, a former chief scientist at the Chinese Center for Disease Control and Prevention, expressed at a special event for investors that, quote, Pfizer's pill will serve a strategic purpose, end quote, and that the move may lay the groundwork for China's COVID containment regime to gradually give way to a more flexible approach. After 2 years of closed borders and a strict zero cases policy, a quote-unquote more flexible approach would be quite a change for the country. I am skeptical, however. Indeed, of all the commentary I've seen on this move, veteran China analyst Bill Bishop's thoughts are closest to my own. He expressed on this point today, quote, I am skeptical this is a sign of any near-term shift in the government's approach to dynamic zero COVID. I expect they would need a massive stockpile of doses, far greater than Pfizer is expected to produce this year for the entire world, before they would loosen up because of this treatment, end quote. And as always, we continue to follow the Evergrande Housing Crisis. By the way, guys, if you're enjoying the content, please remember to hit that like button. It's a huge help for a small channel. And if you're listening to this for the first time and you're getting some value from the episode, maybe consider subscribing. You'll have the most up-to-date analysis on China as I release it every day. Okay, let's continue. From day one, I have argued that because the Evergrande housing crisis is systemic in nature rather than the result of a few bad actors, then, unless there is yet another large-scale credit splurge from regulators, the crisis will unfold like a slow-moving black hole, sucking others in the industry into its downward spiral. The process has begun for China Vanke, in English spelled Vanke, which became the second largest Chinese real estate firm by sales last year, up from third in 2020, a property developer almost 50% bigger than Evergrande. In a recent special message, the chairman of China Vanke urged his staff to prepare for war as the company fights for its very survival. Quote, "We are on our last legs, which means there is no other options. Many of us have not comprehensively understood the situation we find ourselves in," end quote. Hong Kong-based South China Morning Post reports that the chairman said the so-called golden age of the past 2 decades, when home prices only went up and developers made billions of RMB from selling homes, had come to an end. Caixin reports that this real estate giant is planning to shrink its balance sheet and take cost-saving measures as the nation's property market shows little sign of recovery. We remember from a few days ago, according to China Real Estate Information Corporation, the collective sales volume of China's top 100 developers fell 41% in January from last year to 526.6 billion RMB, approximately $8.3 billion US, versus a 38% contraction in December. So just how well did Vanke perform in January? Well, according to a stock exchange filing on Monday, Vanke reported a 50% drop in contracted sales in January from a year earlier. 50% drop, so worse than the average across the industry. And the Chairman Yu, predicts a collapse in company income this year. Quoting his message to his employees again, quote, "We must let everyone know that we are now fighting a war. and everything is not the same as before. End quote. Analysts at Industrial Securities Co. Limited wrote in a note last month that with state-owned Shenzhen Metro Group Co. Limited as its largest shareholder, Vanke has been able to avoid a liquidity crisis faced by a number of debt-ridden property companies since late last year, most infamously Evergrande and others. Its financing remains smooth, was the opinion of the analysts last month. However, analysts are now increasingly concerned with these developments, with Vanke, like Evergrande, a collapse could be systemically devastating. Indeed, it would be worse than an Evergrande collapse, not so much because it's bigger than Evergrande, but because its largest shareholder is state-owned. A Vanke collapse could devastate investor confidence, as even directly state-backed property firms wouldn't be safe for capital. China finance expert at Peking University Michael Pettis observed on these developments today, quote, Vanke is running into a classic financial distress spiral. He, referring to the chairman, wants employees to share in the downside, but the incentives of employees, customers, creditors, suppliers, and even managers are very different than those of the owners. And as they act to protect themselves, they will just drive the company deeper into trouble. End quote. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.